Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining me today is Jared Dillian, author, ETF trader, and founder of the daily GertNap newsletter, a former colleague of mine. Jared, thank you so much for coming on the show today.
Hey, thanks for having me.
Great to have you.
Yeah.
So, we had quite a day so far in the markets. Payrolls, the last payrolls before the Fed meeting, and looks like the market sort of likes the results. Do you have any quick thoughts on that?
Yeah, I think there's something for everybody in the payrolls number. The last payrolls number was very weak, but it was because of storms, or at least that was the excuse as to why it was weak. So I think the expectation was that this number would be very strong, and it was a little bit stronger than expected. The bond market likes it. The dollar is a little bit stronger. Stocks are up a little bit. So, like I said, something for everyone.
Right. Well, one thing I wanted to discuss is there was a big article in Bloomberg today that said the ETF market has taken in $1 trillion so far this year, and when we were at Lehman together, you said the second biggest ETF trader on the street. Can you give us an idea of what that market was like then compared to what it is like today?
Yeah, I mean, ETFs didn't come out until 1996. The first ETF was actually listed in Canada, which was, I think it was a TSX ETF. So it's, the funny thing is that ETFs are not even an American financial innovation, like the first one was in Canada. During the time that I was trading ETFs, from 2004 to 2008, there was virtually no asset growth in ETFs.
That's amazing.
Yeah. And people were basically using them for intraday directional trading. So at Lehman, our clients were 90% hedge funds, and it was all intraday or short-term trading. But ETFs were not used to accumulate assets, and that changed sometime around 2009. If you look at a chart of assets in ETFs, it was flat throughout the 2000s, and then in 2009 it started to grow significantly. And now, ETFs are widely accepted as places to invest if you're a retail investor. So I mean, the popularity has just gone bananas. I didn't know the number that you mentioned, that they've gotten $1 trillion in assets this year. I mean, that sounds about right. There's all sorts of unintended consequences of that, but overall, I think it's been a good thing.
So when you were trading, and I remember you talking about it in your book Street Free, these hedge funds were aggressive, and oftentimes you get picked off. How is the execution? How did you execute an ETF trade back in the 2004 to 2008 era?
Well,
or cover your risk, so to speak.
First, I'll say now, the hedging of ETFs is all algorithmic, right? So if somebody sells 250,000 shares of an ETF, there's a quantitative trading firm, Jane Street is an example, who has very sophisticated algorithmic hedging techniques to hedge with as little market impact as possible. Back then, it was very mechanical. If somebody sold me 250,000 shares of XLE, I would just take a basket of stock and sell it as a market order to hedge that trade. So it was a very ugly execution, and you would butcher it, but you would be hedged within a matter of seconds. And now, like I said, it's a lot more sophisticated, and what I think these trading firms do is they sort of have a central book where all the deltas that they're trading are being hedged slowly over time with as little impact as possible. So it's way more sophisticated than when I was doing it.
What was it? How did you grow from sort of when you started on the ETF desk and then eventually you were running it? But how did you grow it so much in that relatively short amount of time?
Well, when I first started running the ETF desk, my boss, who was the head of derivatives, came to me and he said, look, your job is not to be a trader. Your job is to be a marketer. You have to market the business. So I was 30 years old, and I was like, I don't know what the hell this guy's talking about. what does he mean? Do I take out TV commercials? Do I, do I have like billboards? Like, how do you market an ETF business? So I got the idea that I would start to write market commentary. So in 2004, I started writing these Bloomberg messages, and I started out with about 20 people on my list. And over time, it grew into thousands of people. And the context is that this was during the housing bubble, and I was a really big housing bear, and there were a lot of hedge funds that agreed with me on my housing thesis, and we started getting all their ETF business. So we went from about 22 million in revenue in 2004 to 90 million in revenue in 2008. And we stole a lot of market share from the other banks. So we went from being the 8th biggest ETF desk to the 2nd biggest in 2008.
And I think I remember getting some of those ETFs. I was kind of with some of those Bloomberg emails. I was kind of a late arrival at Lehman Brothers. But before we get into it, Daily Dirt Nap, tell us a little bit about the culture of Lehman Brothers. And you spoke about it in Street Freak. You really love the place.
Yeah, I did. It was, there was zero bureaucracy. I mean, I don't know about where you worked, but where I worked in equities, nobody kept track of vacation days. I did not have to apply for sick time or vacation time. Nobody kept track of it. If I didn't come to work, nobody cared. As long as you were making money, nobody cared. As long as you were profitable. And as a result, I took 9 vacation days in the 7 years that I worked there.
It's probably not too healthy.
I took like no time. I had sick time. I got sick a couple of times, but in terms of vacation days, I only took 9 days off. And 5 of those were in 2007. I actually went to the Bahamas. But there were years where I just took like no time off because I love my job. I love making money. I love trading, and I just love coming into work. So
you were in the Coast Guard for some years before that.
Yep.
Graduate from the academy, was an officer. This must have been completely different from what you had in the Coast Guard.
Yeah, it was a big culture shock. There are rules in the Coast Guard, and on Wall Street there are no rules. I learned that very quickly when I was in the associate training program. So when we were in the associate training program in 2001, they told us, this is in the process of where we're trying to find a desk, and they said, don't only go to the desk during your slotted interview times. Don't go any other time, right? So I'm like, great, like that's what I'll do. So I would go down to the desk for my interviews, and all of my classmates would be on the trading floor like politicking for a job. And I'm like, you guys aren't supposed to do that, right? But like that's Wall Street. Like there's just no rules, You ask forgiveness rather than you ask permission. And eventually I came around to that. When in 2006, 7, 8, I started trading prop, right? But I didn't ask permission to trade prop. And if you think about this from like a compliance standpoint, like I could just open an account with the back office and trade in the account. There was no permissions required. So I just had this enormous prop book, and I was making 15, 20 million a year trading prop, and like as long as I made money, nobody cared. Never asked anybody's permission.
I remember you saying that you had a bigger treasury position than the treasury desk at Lehman.
There was one point where I had a curve steepener on in 2007, where I was long $1 billion worth of 2-year notes and short 200 million worth of 10-year notes, and which I don't know what the DV01 is on that, but it was probably like 125,000, per basis point. And it was an enormous position, and I made $5 million on that trade and took it off way too early. So,
and I've been, we've both been in Wall Street a long time. It used to be a lot more fun than it was. There were some rules, but not a lot. And now, after Dodd-Frank and the Volcker rule, I think the game has totally changed. I don't know if Lehman were still around. I don't think it would be the same thing. The biggest risk place I'd ever worked at was right after Barclays bought Lehman. I stayed with Lehman and managed to get a job with Barclays, and those guys had some really big appetite. But I think that's changed. That changed when when the CEO was basically forced out by the Bank of England, and the whole regulatory regime is different now than what it used to be. But it was a lot of fun. I remember nobody kept track of our trading days, our holidays either. As long as you didn't really take the piss, or you made sure that there was somebody covering for you, people really didn't count. It was a wonderful way to work, actually.
Yeah.
Can you just give us a little insight on sort of towards the end of Lehman Brothers, in a nutshell? Why do you think it went down like it did?
It went down because of the decisions of a few people in senior management. Dick Fall, Joe Gregory, a handful of other people. Um, it was not. I don't view Lehman's failure as a failure of capitalism or regulatory failure or anything like that. It's simply, and the other thing I'll add about Lehman is, to this day, a lot of people think that Lehman's management were criminals, that they were charged for fraud. There was no fraud. There was absolutely no fraud. Lehman went down because of terrible decision making, because they bought $40 billion worth of real estate, like actual real estate, because their mortgage portfolio was hundreds of billions of dollars. It was leveraged 35 to 1. Like, that's why they went down. And I think that as a result of that, I mean, because of Dodd-Frank and higher capital requirements and stuff like that, it would be very hard for another bank to leverage up to that extent and fail like Lehman Brothers did in 2008. It would almost be impossible. So.
And I just want to go down a rabbit hole a little bit here, because I've thought about it often myself. Counterfactually, if Henry Paulson had told President Bush, we need to bail out Lehman because if we don't, the consequences will be more dire than we can imagine. Do you think that would have changed the arc of the financial crisis and where we are today? Or do you think it was so top-heavy that it may not have made a difference?
I think it would have prolonged the financial crisis. It would have, the thing with Lehman failing is that it caused panic selling. The stock market was down 19% in a week, the week that Lehman went bankrupt. So you found a clearing price very quickly. And one thing people forget about the financial crisis in general is that the whole thing happened very fast. From the summer of 2007 to March of 2009, it was over in 21 months. That's very fast, right? And part of it was because we were allowed to find those clearing prices. I'm actually more concerned about the social implications of what would have happened if Lehman was bailed out. I mean, it was bad enough even with Lehman not being bailed out. In 2011, we had Occupy Wall Street. Everybody was mad at the banks. And let me put it this way. If taxpayer money had been used to bail out Lehman and then people found out what was inside Lehman and the risks that people were taking, that taxpayers' money was being used to bail them out, I mean, there would be hell to pay. So
fascinating. So it was bitter medicine, but we found a clearing price relatively quickly. I want to get back a little bit to what you started. You were such a successful trader and marketer because you start writing these Bloomberg notes that came out every morning. Is that the genesis of the Daily Dirt Nap? Because you essentially said, I'm not going to go work for another bank, though certainly you could have with your results on the street. What was the thinking about saying, what, I'm not going to work at a bank anymore and I'm going to start a newsletter?
Well, I had a few thousand people on my distribution list, and I was kind of running some numbers, and I said, look, if I get 20 or 25% of them to sign up at $600 a person, then I should start out making $400 grand a year. That's what I thought would happen. The reality is that I was very burned out from trading. Like, the stress of that job was taking a physical toll on me. When Lehman went bankrupt, I was actually happy because it would allow me, it gave me an excuse to leave and do something different. When Barclays came in and bought the investment bank out of bankruptcy, and I found out that I still had a job, it became a very difficult decision because I was being offered a lot of money to stay. So at that point, the decision to walk away was very hard. But that's what I did. So.
And just give me an idea of like what the first couple of months was like when you were like sitting in a room writing this newsletter instead of trading.
Well, a newsletter is not a complicated business. There's not a lot of overhead, so I didn't have any room in my house, so I got a small office in the city on Third Avenue, which was literally like 60 square feet. It was a closet with no windows. And I actually regret I never took pictures of that office. I would love to show people that office someday. Um, so I got a computer, had the internet.
Bloomberg subscription.
I had Bloomberg. I mean, that's basically all you need is some tech stuff with the email. And um, the first, I started publishing, I want to say October or maybe November of 2008. And already I said to myself, this is a big mistake. I was coming into work. Um, Citigroup was trading at 99 cents. Bank of America was at like $3. Everybody thought all the banks were going to go bankrupt. And I was like, this is the worst time in the world to start a business, is right in the middle of a financial crisis. I used to come into work and I was so stressed out. The first thing I would do would be to puke in the trash can. I would sit down on my computer and I would just puke in the trash can and I would just get to work. And I did that for like 3 months.
Wow.
But the cool thing is that as of January 1st of '09, I started getting orders. Like people started subscribing, and I had maybe $100,000 or $200,000 in revenue in January of 2009. So I said, okay, like this is not going to be a failure. Like I can start with this, and it just grew over time.
What's been, I mean, and you've been phenomenally successful in the 15, 16 years since then. What's the secret to, the secret sauce on the Daily Dirt Nap? Because it's a little bit different than most market newsletters.
Well, actually, if you think about it from like a business strategy standpoint, the newsletter was an innovation of sorts. It was a tiny innovation, but it was an innovation. And up until that point, you have to remember, back in 2008, there weren't that many newsletters. There was Grants, there was Gartman, there was a few other, there were some blogs, but they were all boring, right? They're all very dry. And the Daily Dirt Nap was really the first publication to combine humor and insight with financial expertise. Um, and so, and that made it incredibly successful. Now, since then, I have imitators. I have people who try to do the same thing, and there's a lot more competition in the newsletter space than there was back then. And that was actually, one good thing about it is that I started so early that I really did not have much competition.
How did you come up with the Daily Dirt Nap as the name of the newsletter?
Well, Dirt Nap was a word that I got from the P Coast. I used to be a clerk on the P Coast, and all the traders on the floor used to say Dirt Nap all the time. They were like surfers. It was like a surfer word. And they'd look up at the screen and they'd be like, dude, the spoos are taking a hella dirt nap. And they just kind of had their own language. And I brought it back to New York, and I used to say to Lehman, and it's become part of the lexicon.
Um, so moving ahead to today, in today's issue, you wrote that you're actually quite bearish on the stock market right now. Do you want to talk about that a little bit?
Yeah, I try not to really advertise that bearishness, because then you get a reputation as being like this perma bear, like this angry perma bear. But when I look around at the stock market, at the economy, there is risk taking to a degree that I literally have never seen in my career. And I lived through the dot-com bubble, and this, I would say, exceeds that in some ways. I would say the mania in the dot-com bubble was more extreme, but I think today, many more people have exposure to the stock market than they did back in 1999, right? Like I would say 60% of people in the U.S. own stocks in some way, shape, or form. The stock market is way overowned. You're starting to see, just divergences between U.S. and the rest of the world that are just totally unheard of. So I am bearish, but my job as a newsletter writer is not to be bearish for 2 years all the way up and just impale yourself, but to try to find the exact moment at which it makes sense to get short. And I don't think it's time yet, honestly. I think we have a little ways to go. I think the inauguration could be a potential catalyst, but I don't know. But that's my job, is to find the exact moment.
You talk about sentiment a lot in the newsletter, and you said you're sort of the master of sentiment. That's your sort of go-to, rather than being a news hound or trying to look at every headline. So do you look at, I guess, when sentiment goes too far in one direction, is an important signal for you?
Oh yeah. I mean, the thing with, and it works in all asset classes. It's not just stocks. It's bonds, it's commodities, it's FX. Um, like, now, the way I measure sentiment is not quantitatively. There are some people who do that. There's a firm called Sentiment Trader who does all these quantitative measures on the stock market to determine sentiment. I just do it anecdotally. I do it through conversations with people, even people in Myrtle Beach, conversations with people in regular jobs, how they feel about the stock market, commercials you see on TV, things you see in movies, newspapers, the covers of magazines, stuff like that. And a lot of it is Twitter, like what people say and feel on Twitter. I always tell people I don't need to see the chart of a stock. I don't need to see the price. All I need to see is how you feel about it in order to trade.
It's interesting. So I've talked to a couple of people in the course of some interviews, and they're saying that they're hoping the market stays up here through the end of the year because they don't want to take the tax hit and take profit this year. They would like to actually maybe trim down some positions in January, which may coincide with your thinking about the inauguration.
That's interesting. I hadn't thought about the tax part of that. Like, nobody wants to take gains this year for sure.
Right. So back it off till next year, and then you have a whole year to worry about it. But if you have some big gains, maybe if you can wait till the first week of January or sometime in January, maybe better than doing it this year. At least a couple people have thought about that.
There's been a couple instances when that's happened. I want to say 2004, 2005. The market dumped like 6 or 8% right out of the gate in January. I think it was a similar setup, so that could happen.
So moving a little bit, you've written, despite all the things you've already done, you've written 5 books. There's the latest is a short fiction, but you also had a book that I want to talk about a little bit. It's called No Worries: How to Live a Stress-Free Financial Life.
Yep.
And one thing you mentioned that, and this is for sort of investors. You're not incredibly sophisticated investors, but the investors who have substantial money in the market. You talked about something called the awesome portfolio, your ideal portfolio. Can you expand on that a little bit?
Yeah. So basically, I think the way that people invest for retirement is really dumb. Okay. So maybe at the core, the advice somebody might get is put all your money in a stock market index fund and just ride out the volatility and hold it to you retire. Or maybe you have a 60-40 allocation. So I'll tell you what's wrong with both of those things. The S&P 500 index fund has great returns, terrific returns. But when you invest in an index, you not only get the returns of an index, you also get the volatility of the index. S&P 500 is very volatile. On an average day, it moves 1%, right? An average month, it moves 4 or 5%. You have had years where the stock market is down 30, 40, 50%. So my position on this has been that you cannot expect people to ride out the volatility, okay? Because they will freak out during a drawdown and sell and stop compounding, right? So what people spend a lot of their time doing is trying to coach people not to sell and hold on. But people forget, there was a time in our history when the stock market went down 89% over the course of 4 years, from 1929 to 1932, So can anybody ride out an 89% drawdown?
Probably not.
And invest and stay invested for the long term? And you say, no, that'll never happen. And I'm like, no, it could happen. Like, it could happen. I mean, in 2008, from 2007 to 2009, the market was down 57%. And you're asking people, they have $1 million saved up, and that goes down to 430,000, and they're not going to panic and sell. And another thing is that even if they had the ability to hang on, they would be miserable. They would be so stressed out. So why not structure your portfolio in such a way that you don't have to experience that stress? So what I came up with is the awesome portfolio, which is 20% stocks, 20% bonds, 20% gold, 20% cash, and 20% real estate. And we're going to recalculate this at the end of the year, but as of last year, the awesome portfolio has returned 8.1% a year, so just a little bit less than the stock market, with half the volatility of an 80-20 portfolio, and a max drawdown in any given year of 12%. So the worst you can do in any year with the awesome portfolio is 12%, and it returns a little bit less than the stock market. Why wouldn't you want to do that, right? It takes all the stress out of investing. Now, 8% versus 9%, I mean, that's kind of a big difference. Like, you end up with a lot less money in retirement, but I would say that most people, if they're invested in an index fund, they don't realize that 9 or 10%. They don't, because they don't dollar cost average perfectly. They buy more at the highs, they sell at the lows, they don't invest at the lows, and they don't realize that number, so they're better off with the awesome portfolio.
How would a typical investor invest in real estate? The 20% part of the awesome portfolio.
One of the things, and I'm actually going to have a book about this, like the Awesome Portfolio book is going to come out in 2026. What I say is that if you have equity in your house, you can consider that as part of your real estate allocation, right? So if you have a $600,000 house and you have $300,000 of equity in your house, and you have $300,000 in cash and $300,000 in gold and $300,000 in stocks and $300,000 in bonds, then you have the awesome portfolio, right? If you don't own your house, if you're renting and you don't have any exposure to real estate, then just buy a REIT ETF, right? And the one I typically guide people towards is VNQ, which is the Vanguard REIT ETF, right? So that's how you get your real estate exposure.
And then you've been a fan of gold for a long time, and it's had a phenomenal move this year. Do you see that continuing? Is this a new dawn for gold, or just happens to be an amazing year, and then we'll kind of settle for some time?
I mean, we've known each other a long time. You know, I've been bullish on gold for a long time, and it's been a great year. I'm not a gold permeable by any stretch of the imagination. There's going to be one day when I sell all my gold, like that'll happen. I still think that's a ways off in the future. Gold is up about 35% this year-ish.
Wait for the Economist to put it on the cover in some amazing way.
Yeah, something like that. The one thing I'm a little bit concerned about with gold is that we have Scott Bessent as the Treasury Secretary, and he's trying to thread the needle on the deficit. So if you have a Treasury Secretary who is concerned about deficit reduction, that's gold bearish, right?
Gold fell to $100 in the 2 days after he was announced. That was phenomenal. It's like the second coming of Robert Rubin or something.
Yeah. So I don't know if Bessent will succeed or fail, but that is a reason to be bearish on gold in the short term.
I want to move a little bit away to one of the topics that you've spoken about, and I want to get your general thoughts on this, is private equity. You've been critical of some aspects of private equity, and what it's doing to some of the they're rolling up Jersey Mike's. Should private equity be rolling up Jersey Mike's and rolling up car washes?
Well, Jersey Mike's is actually a business that kind of makes sense to roll up because it has stable, predictable cash flows, and so do car washes. But private equity, the idea that you would have a 33-year-old jerk at a private equity firm who understands Jersey Mike's business or understands the business of a dental practice or a car wash or whatever, all they really know how to do is to cut costs and raise prices. That's the same formula that they apply to all businesses. So it just makes everything worse, right? And also, you know, there's private equity made sense 10 years ago when interest rates were zero and you could buy businesses at 4 or 5 times EBITDA, and now interest rates are 5% and you're buying businesses at 10 or 12 times EBITDA. Like, it doesn't make any sense. So there's way more private equity firms, there's way more competition for deals. They're getting done at higher and higher valuations, and I don't know who they're going to sell them to. That's the thing. So exits are way down. Like, the PE firms can't exit these portfolios. They're flipping them to each other. So this is all going to end very badly.
Do you have a sense of when the reckoning might come? Is it 3 years, 5 years? But it just, you're buying too many things at too high prices, and
Yes.
you can't, and you're already having trouble getting out.
Yeah.
And now, in addition to all the things you're writing, and you also teach at Coastal Carolina University.
Yeah.
What has teaching these students finance taught you, actually?
What has it taught me? Well, I guess one of the things you have to think about when you're teaching college students is you kind of have to remember when you were a college student and how little you knew about things. Like, when I went to the Coast Guard Academy, like, I didn't know anything about finance. It was funny because I remember they used to put us all in a lecture hall, and they used to give us a 1040 EZ, and we all had the same financials, and we would all do our taxes at once. And I had no idea what the hell I was doing. You know, they would have everybody fill out a 1040 EZ. So, and now they don't even have 1040 EZs anymore. Yeah, when I was a college student, I didn't know anything about finance. So it's funny. So you're in a class and you're teaching about the housing market, and you start talking about Fannie and Freddie, and they have no idea what you were talking about. They never heard of the GSEs. The financial crisis was 16 years ago. There were two when it happened. They don't know what the GSEs did in the financial crisis. There's all this context, and it's funny. Like, you know so much, and it's hard to communicate it. So anyway, it's a lot of fun. So.
Well, we're running a little bit short on time, but what I'd love to do is talk a little bit about the CTA that you opened, Armington Capital. So
Yep.
you're writing, you're teaching, you're doing a daily newsletter, and yet you opened up a CTA, for investors who want to come in. What's the thinking on that in terms of, are you, is it a shorter term, a longer term? Ideas that you put into CTA, and the positions that you put in?
Well, first of all, let me say that I'm a trader. It's in my blood. Once a trader, always a trader, and I was a successful trader. And even after I left Lehman and I transitioned to writing, I always traded my own money, and I've always done pretty well at it. Not amazing, but pretty well. And I would say around 7 years ago, I started thinking about the possibility of managing outside money. And then somebody talked me out of it. They said, your life is going to suck. Don't do that. So I didn't do it for like 7 years, and I came back to it, and I'm like, I think at age 50, I finally have the emotional maturity to be able to handle the stress. And I got to tell you, the first couple weeks were incredibly stressful, and I'm like, why the hell am I doing this? But now I've gotten to a point where I've kind of reached an equilibrium, and it's not that much stress, and I'm enjoying it. It's a new challenge. I'm a big fan of doing new things when you get old, So.
Any thoughts on themes for at least the first few months of 2025?
I really don't. I have a sense that Trump is going to turn out to be negative or bearish for quite a few sectors in the S&P. Tech in particular, healthcare also with RFK Jr. He wants to cap credit card rates. The funny thing is that, not to get too much into politics, but I actually think there's a chance that Kamala might have been better for the stock market. Not to say that she would have been better for the country or she would have been better for small business, but she might have been a more corporatist president and been better for big business. there's a lot of Republicans. Josh Hawley is an example that are very populist and are anti-big business. And I think there's a possibility that this could result in stocks going down. Also, the other thing I'll point out is that Reagan, in his first term, 1981, Reagan put in all these free market reforms, and the stocks really didn't go anywhere for like 3 years. They didn't start going up until 1984. They went sideways for 3 years. So something similar could happen this time, So I'm not. I guess the point is, for the beginning of 2025, not super bullish on stocks.
You said something about credit card rates that you wrote about. I think that's important. Why is, for most Americans, 25% interest rates on credit cards or 30% seems really high? But why is it a bad idea to cap credit card rates?
Well, it's basic economics, right? So it's a supply-demand diagram. You have a downward sloping demand curve. You have an upward sloping supply curve. You have an equilibrium price. If you hold the price below equilibrium, demand exceeds supply, and you have a shortage. If you cap the price of corn, you would have a shortage of corn. If you cap the price of credit, you have a shortage of credit. So what this means is that, from a practical standpoint, the vast majority of credit card borrowers are unprofitable at 10%, and they will simply lose their accounts. Capital One, Discover, they will just cancel their accounts. And if you have a credit score of 780 or higher, then you get to keep your account because you're profitable at 10%. So you will have a shortage of credit, which will push people into payday loans. It'll push people into title loans, loan sharks, and stuff like that. It'll create a black market like a lot of price caps do. So
like a Costanza, like sort of the unexpected. You're basically telling the credit card companies, if I can't charge some people who need 20% to be profitable, I'm actually going to close the card and let them go somewhere else.
Yeah.
So it'll have the almost exact opposite idea of what it's trying to do. It'll actually hurt the people who need it the most.
Yeah.
Well, thank you so much for coming on the show today. Hopefully next time you're in town from sunny and warm South Carolina, we'll have you on the show again. Thank you so much.
Yep.
And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sompro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back here Monday. Have a great weekend.